Okay, well, welcome everybody to our panel this afternoon about venture capital in general, and we're just delighted to have you all here for a broad-ranging discussion about venture. It's been an incredibly exciting period for venture capital, especially over the last 10 years. I'm a class of 2007, along with several panelists, and so much has changed since then. There's the rise of accelerators and micro VCs and this resurgence of corporate venture capital as well. And then this lexicon has changed, which has been really interesting, right? When we went to school, there was no such thing as a unicorn, let alone a decacorn. Now there are nano funds, micro VC, Shark Tank, pre-seed. I mean, it's really changed. So looking forward to diving into some of those topics today as well. So my name is Michael Berolzheimer, class of 2007 on the full-time MBA program. Go Bears! Yeah. And I'm just delighted to be here in Moderator today. Ever since I graduated from school here, I've been involved in the entrepreneurial community, both on campus and off, and was lucky enough to be the first investor in 2Mogul, which was one of our classmates in the class of 2007. And those guys put me personally on the map. I'm very grateful for that experience and started a fund called B Partners, which is a pre-seed venture firm. And we do first check writing into companies on the frontier curve of innovation. So we have an absolutely outstanding panel today coming from all swaths of venture, representing both smaller seed funds like XSeed Capital with Lev Mass, as well as Wes Selke from Better Ventures. We've got one of the most famous and best performing corporate venture capital firms in the world represented here with Lo Tony. That would be formerly known as Google Ventures, now GV. And then we also have the LP perspective here with another classmate of mine, John Coelho, from a group called StepStone Global. So John's going to be able to provide us with a little bit of the perspective from the capital side of venture capital. But before we jump into it, we want to make sure this is super interactive. I mean, you got 5 venture guys up here. We can talk for hours and hours and bore you to death, and so we want to make sure we don't do that. And so before we jump into it, I want to make sure this is highly interactive. We're going to get into Q&A right away. If there's a question that you have about some comment that we make, just jump in here, okay? You don't need to raise your hand, just jump right in and let's make sure this is interactive. But before we start, I want to canvass the audience that we've got here. So by a shout of Go Bears, okay? So by a shout of Go Bears, how many of you are founders and aspiring entrepreneurs? 1, 2, 3. Go Bears! Wow, nice. All right, that worked. I wasn't sure if that was going to work. How many of you are aspiring venture capitalists? 1, 2, 3. Okay, there's a few of you. All right, good. Nice. And then, how about other? 1, 2, 3. Yeah, okay. All right, good. So we got just some curious people in the audience. I like it. All right. Well, good. Let's start, you guys. I think it's probably best for us to just kind of get a landscape of what's the state of the venture capital market to start. So we've seen that activity is down, volume is down somewhat, actual capital deployed is down somewhat to some previous levels. But John, you've got the widest exposure and breadth of view on the panel. Maybe you can share a little bit with us about what's going on in the market these days.
Yeah, of course. I'm happy to be here. So I guess I would probably push back on that notion that the venture business is recoiling. It's it has grown quite dramatically in the last 10 years since we graduated.
Right.
And so my view is that we're in a pretty hot venture market still. Even if investment pace has come down, there's still a ton of capital out there searching for deals. So 40 billion raised in closed-end venture funds in the U.S. last year. That's the highest, I think, since the 2000 bubble.
Wow.
And that actually excludes a ton of shadow capital.
Right.
Some of it's corporate VCs, but some of it's sovereign wealth funds and hedge funds and folks, like StepStone, family offices have been very active.
Yep.
So we're operating under the assumption that we're in a pretty hot market, and we're very focused on trying to find differentiation. And so I just think software and internet's pretty expensive right now, and so because we're deploying capital and customizing portfolios for institutional investors, we take a multi-stage, multi-sector, multi-geography approach. And so in that environment, we're more focused on things like biotech, where we think there are real barriers to entry. We're looking at things like growth equity, as we define it, like bootstrap companies that have avoided raising venture money. That's a pretty interesting theme for us. And then also, there's a lot of nascent venture markets around the world that have become a lot more interesting in the last decade. I think, in large part because of what's happened in the IT stack with the cloud and open source. But, places like Tel Aviv and London have been vibrant venture markets for a while, but now we're starting to see a lot of ecosystems blossoming around the world, and I get into that.
How many of us in the audience are not living in the Bay Area, if I show of hands? And then keep them up, and then drop your hands if you're still US based and now you're international. Okay, good. All right, so we've got some folks from the rest of the world. Yeah.
Because you hit on a point that I am facing right now. I joined the company 10 days ago. It's been bootstrapped since 2011. We're doing probably decent revenue, but the company's really in a position to. Okay. Who invented this? The company's really in a position to kind of hockey stick from here. We've got a project finance deal going on, and it's kind of the chicken before the egg kind of problem. So where does a company like that fit in the VC space today? So, I don't know the metrics of the business, but it sounds like it's pre-profit, or is it profitable? You're on the cusp of a big commercialization.
Depends on the quarter, and it's profitable. It needs to be run better, which is one of the reasons why I'm there. And we really kind of need a small amount of capital to unclog backlog, and if that makes any sense. So we've got a product. It's been certified. It's gaining market acceptance. We're growing revenue. What scares me in my position is that we're going to hit this growth, and we're not going to really be prepared to handle it. Because we don't necessarily have the capital to deploy right now. CEO's focused on cash flow, generating profits. I'm focused on setting us up for where we're going to be 6 to 12 months from now. And we're exploring a capital raise. We're talking to a few people, and I just wanted to get your guys' opinion of kind of where a company like that would fall.
Yeah, without knowing the business and whether it's sort of tech-enabled services or like pure play software.
It's energy technology with a little software in it.
Okay, interesting. I think, so the venture community is attracted to hockey stick situations, right? And like the ability and incredible inherent leverage in the model, whereas moving more to kind of the growth equity play, I think we're seeing a lot of smaller sort of lower middle market funds that are investing in, bootstrap companies. They might have a tech-enabled lens, but they're not going to raise, tens or hundreds of millions of dollars in the pursuit of a splashy IPO. So I think it's oftentimes the company needs to sort of make that philosophical decision as to what are they? Do they want to take on outside investors and stomach cash burn in order to go after the big splashy outcome, or is it more of a kind of blocking and tackling, or not wanting to take the dilution? So one of the benefits of raising once you've hit milestones, commercial milestones, is you can command a better valuation, right, take less dilution. So I often advise entrepreneurs to be very thoughtful in the ways that they bring on capital partners. And
so that said, though, there's this inherent mismatch, right, of great companies that are growing very well, and yet the vast majority of returns come from the few minority of companies. In fact, it's called the power law curve. I'm sure that many of you in the audience understand this, but 60% of returns come from only 6% of the companies. And so, perhaps you guys might be able to share with us in the partners meeting, how does the power law curve impact your decision making when you're looking at an opportunity that that may very well be on a fantastic trajectory. Maybe you guys can talk about how that impacts your decision-making process. Lo, you wanna kick us off? And
Sure. I'll give some insight into what happens at the partner meeting after the meeting, right?
The meeting,
Meeting after the meeting. What do we really talk about? And that's one of the things that we do talk about, because when we think about the mixture of companies that comprise our portfolio, we do think a lot about what is the ability for this company to be able to hit a certain trajectory and have a certain exit. So we talk about, and the person that's leading the deal has done a lot of diligence to be able to better understand kind of what does that growth look like, what are some of the barriers, what are some of the multiples, and then we collectively talk about those multiples and what we think the company can achieve at exit. And it does impact our decisions greatly. I mean, I like to say that at GV, I mean, we are blessed to be in a position where we operate off of a fantastic platform and we can see a lot of opportunities. We, unlike most corporate VCs, we do focus exclusively on financial returns, so we think and operate more like Andreessen Horowitz, Greylock, or Sequoia than some of the other corporate venture funds. And these are the exact types of conversations that we have because we need to achieve a certain objective. And I would even say on the other side of the table, advice to entrepreneurs is to really think about the economics of a venture fund and the fact that it's based off of not only the return itself, but ownership. Ownership matters. So it doesn't matter if you've got a couple of $1 billion exits if you only had a minuscule amount, so it doesn't really move the needle. So we're focused on both the return itself as well as our ownership position. So kind of great things to think about both for the venture perspective as well as the entrepreneur trying to get money.
So Wes and Lev, share a little bit more about this power law conundrum. You know, at the end of the day, when you're finally making the decision, how much does that come into play when you're making that decision of saying, is this a company that could be one of those 6% in the entire ecosystem of venture capital?
Yeah, I mean, this gets to portfolio construction, and this is probably the #1 topic that my business partner Rick and I talk about, including at our advisory board, which you obviously come to, Michael. This is he's one of our advisors, and he's got decent advice. It's pretty good. Yeah, I mean, portfolio construction is such a big one, and our rule of thumb is every investment should have the potential of returning 1x the fund. And on a sort of good but not necessarily, you know, unicorn, decacorn, nanocorn, whatever kind of corn you're talking about, kind of outcome.
Awesome.
And what's beautiful about us, we're a $21 million fund, and there's a beauty of small funds, and that is if we own 7% of a company that gets acquired for $300 million, we've just returned 1x the fund. And so that's the kind of math that we do when we think about our portfolio construction. And as we've added to the nomenclature over the years, we've actually coined a new term at Better Ventures, which is called the camel. We love camels. They're kind of like unicorns, except they can survive on much lower amounts of capital. So maybe it's similar to what you're talking about. So we're always on the hunt for camels out there. So if you know any, camels that are focused on, big social and environmental challenges, send them our way.
Hey, Lev, take us from the entrepreneurial perspective. So we've just heard about returning the fund. We've heard about this power. Like, how does a founder translate that into the story and the pitch and the conversation that they're about to have when they're seeking capital in this reality that we're all seeking that outsized return here?
Sure. So as a seed fund, it's my job to make sure that the entrepreneur can raise the next round, so Series A. And a lot of entrepreneurs don't think about how long it takes to raise capital. A lot of times, when I talk to entrepreneurs, they'll raise, they'll say, I want to raise $1 million. And you ask them, why $1 million? And they can't really give you a good answer. So I think really, my first question really is, how long will that money last you? And have they really thought about that? Because fundraising conservatively takes at least 6 months, if you have a good idea. And, so you really want at least 18 months of cash for you to raise that next round. And what we're seeing, at least in SaaS, is that you need to be about 200,000 in monthly recurring revenue in order to raise a Series A from a larger institution. So, so going back to power law, I think, we don't look for necessarily unicorns or camels. I think maybe we look for zebras. We're looking for, and we're looking for, generally we look for companies that are either in underserved markets or have a sort of a blue ocean strategy as they're carving out a new market. And can they really be, a $1 billion business, at least on valuation? So like 100 million in revenue, and I think the power law curve is, generally for a seed stage fund, how we look at it is, can this business be a $1 billion valuation company, but not necessarily in 5 years. I think it's more important, can you get to a decent revenue traction in 5 years, and since we invest in enterprise software, it's a little different than consumer companies, and the valuation is very different.
So there's got to be an entrepreneur in the audience who is saying, you guys are crazy. Like, why are you always trying to find the $1 billion outcome? I've got a great company. I'm going to make 10, 20, $30 million of profit next year, and it's going to be a pretty good business. What's the response from you guys as to how those folks can effectively finance their companies as they're looking for capital to grow? And they know that they're not going to be potentially a $1 billion outcome, and yet all of the language and our culture is pushing them and driving them predominantly towards a venture capital funded situation. So what's the feedback for them? What's the advice for founders who aren't necessarily on that path?
Yeah, so I actually have a classmate, Charlie Silver, who's like a serial entrepreneur, and he has two companies right now. One is a biotech company that's going to need a ton of cash. And by the way, IPO in biotech is just another funding round. Just because of the regulatory approval process. But he has another company. It turns out that a lot of radiologists get carpal tunnel really early on because they're constantly scrolling through images. And so he basically has a new mouse, essentially, whatever you want to call it, essentially a new mouse for radiologists. Now, I don't know how big market that is, but let's say, there's 50,000 radiologists in the US. So he knows it's not going to be a $1 billion outcome.
Right.
And so he purposely structured it in a way that was more for family offices. And he's going sort of after high net worth individuals and sort of saying, I know this is not going to be a $1 billion outcome, but I think we can get to, say a $30 million outcome. Would this be something that you're interested in? And so it's really looking at sort of the type of investors that you're targeting. And I think that is kind of the flaw of venture capital is, at least in terms of, we are looking for those type of returns because that basically statistically returns the fund. Is you get one company that returns the fund, and then the rest is sort of, say, gravy from there. So that's why you get VCs who are constantly looking for those unicorns, even if they pass on a decent business, it doesn't necessarily return the fund. So I think venture itself is not usually suited for, say, service businesses or businesses that don't have that hockey stick growth.
Right.
And so what, really, I think that's why we have Berkeley Angels Network and a number of other groups that are supporting Berkeley entrepreneurs who are raising sort of who are starting different types of businesses and raising capital for those.
Yeah, John, go ahead.
I just want to make a point. So I think, of course, the venture community is focused on, the decacorns or, the massive outcomes. And so it's, I think, appropriate, and small funds and big funds should aspire for those. But, from my perspective, we invest in funds of various strategies, and we invest in companies as co-investors. So we can, when we're investing in a $30 million seed fund, we don't need to get into Airbnb with that investment to do incredibly well. Mm-hmm. Like that model, and you're investing at sort of sub $5 million pre-money valuations, and you've got reserves to maintain your ownership. You get one, a $200 million outcome if you've got enough ownership that can return your fund, which some call the dragon, right? Is the fund returning deal, to use another. But so then you move to the big brand name funds, right? That's where most of the focus is in the media and maybe in the LP community. So I think the 30 largest venture funds are managing like over 2/3 of the capital in the industry, and they're almost all deploying like billion-dollar plus funds, charging premium terms. So from my perspective, that's, you need to get into a power law deal. You need to get into multiple billion-dollar outcomes to drive a venture return for me as an LP.
When you're in a large fund. But
if you're in Lightspeed or Sequoia or NEA is a $3 billion fund. It's like lightning needs to strike in that fund multiple times to get a venture return.
So we know that it's not going to, whatever company you have right now is going to be different in 2 years. I mean, we all know that we're going to be pivoting and attacking and adjusting over time. From a founder's perspective, once they have our capital and things change and the outcome is not going towards that expectation of becoming a $1 billion outcome or potentially a return the fund outcome, what's the dialogue? How should founders interact with their lead investors when they come to the realization that there may not be that outsized outcome? What should founders do in that case? Lo, you have any feedback on that?
Yeah, so I think open and honest dialogue is important, but I think even before that, one of the things an entrepreneur should do is make sure that you understand going in that things will change, things will get tough, and so on your side of the table, do your diligence to make sure that when you pick your lead investor, it's someone that you want to have to go to battle with when these types of things happen. So I would say first, that's really important, because if you go into a situation and you take a check from someone that you know can be just a little persnickety at times when things don't go well, don't be shocked if you get fired then, right? So you want to have an investor that you feel comfortable with that's going to be, behind you and back you and do all the things that are necessary. Now, back to your question, what type of conversation should you have? I mean, you got to be open and honest, and you have to recognize when things are changing. And this goes back to my comment about recognize what it is that the venture folks are looking for. They're looking for a return. And if you get into that situation, you need to think about your options. But look, the thing that we know when we invest in companies, when the first time we meet with an entrepreneur and they put up their financial model and this great opportunity and like all this great cash flow and this great multiple opportunity, I don't know anything else except for one thing when I look at that. I know that's not what's going to happen.
That's right.
So I know that going in. You need to be able to have the flexibility, the perseverance, all those things that you hear when you're an entrepreneur. But it's important to have an open and honest dialogue with your investor, and then to really make sure that they're telling you what it is. I always say, great when you can have a structure where you have an independent board person. I mean, you need someone that also can be your eyes and ears for the conversations after the board meetings to really understand, okay, I'm hearing this, but is this reality? You need to have someone that you can trust, and that's really important for an entrepreneur as well.
So, let's go to the audience. Let's hear some questions before we move on.
Get started with a machine learning startup, and one of the things that we are trying to figure out is how machine learning can apply to different industry verticals. So when you go into a vertical, does the initial seed round or Series A, do you consider those startups as software startups, or do you consider them as startups that are in that vertical? Does that make sense? And does that change your perspective on how you should invest or who the VCs are who would be investing in those kind of deals? So for example, you can do data analysis on thermostats and apply it to energy. So would a VC who invests in energy would look at it, or would a software VC look at it? Does that make sense as a question?
Yeah, interesting. So you have a horizontal technology potentially, but you're picking one vertical to start with, right? So what's the feedback on founders that are pursuing that effort of wanting to go horizontal, but picking a lane first?
Yeah, I think, majority of successful companies always start in one vertical. Like PayPal started with Beanie Babies. eBay started with Beanie Babies. And PayPal, started with sort of eBay sellers or very small merchants. And, basically, Omid realized that, really early on, Pierre Omidar, realized very early on that, like, these people were collecting Beanie Babies. And they were very vibrant community at selling them, and that's where they started and sort of scaled from there. So I think pick a vertical, pick a vertical where you can be successful and develop your models there, and then you can always apply it elsewhere. Like we did a company recently called Sparta, which is using machine learning to predict sports injuries. And so who can pay? Professional athletes and teams. So like they're starting with professional sports, but professional sports is not really a huge market. But you can think, eventually they can go after military and like UPS and industrial companies. So I think, figure out where your beachhead market is and scale from there. But also, when you're going to talk to a VC, I think, find someone that can add value.
Should they have somebody who adds value to that particular vertical as their lead investor first, or should it be more broad than that?
Well, I think you want somebody who can help you go to market and potentially truly understands your technology, because like everyone's cash is green, right? So like, and as Lo said, basically raising capital from VCs, it's like a marriage, right? You want somebody, you want somebody on your board that you can have an open, honest dialogue with, and that is really there to help you going forward. I mean, there is sort of an adversarial context to some degree, because the VCs is a fiduciary duty to their investors is to the company, not necessarily to the founder. So you want somebody that can help you both go to market in the beachhead that you're starting at, but help you scale to get to those metrics so you can raise money from, say, Google Ventures.
Wes, what kind of questions should founders ask for this fit? And we'll get to more questions, but I want to move away from the return-driven conversation that we've had, because we've kind of had a conversation about the venture capital, the business model of venture and the market itself, and now tilting it back towards the entrepreneur. How do you determine fit? I mean, we talk about it internally all the time at B Partners about how important it is for founders to find that fit, but they hear it a lot, but what questions should they be asking to the counterparty when they're evaluating capital sources?
So what questions should a founder ask a VC?
Yeah,
Okay.
and what are the best
Yeah.
questions that you've heard from founders on this?
Sure. Yeah. I mean, this is a great topic because so much is talked about how we're evaluating entrepreneurs, and obviously you got to do it. It goes both ways. And these days there are a lot of funds, or especially a lot of seed funds out there competing for some of the same deals. I think. Trying to, well, first of all, do reference checks with their portfolio companies. I think at the end of the day, that's probably your best way to really get to know a VC is go call up some of the, off-list references. You always got to do off-list references. I'm going to give you 3 founders that you can call. Obviously, I'm going to pick the 3 that are going to rave about us. Go talk to them, but then, go through our portfolio list on our website and do so. Use LinkedIn to get connected to those founders, and then do off-list reference checks. But I think getting down to obviously, tell me more about how you engage with your portfolio companies. What can I expect from you beyond just the money? We all are sort of competing on some of the services that we provide to founders. Can you give me examples of things that you've done to help other companies succeed? Maybe try to pin them down on a company that didn't go so well, and what they were able to do or how they reacted through that process. And then also think just on philosophy, what are the expectations here? Are you expecting that you want your money out in 5 years? Are you, where are you in your fund cycle is really important. If you're in year 4 of your investment period, you've got a shorter time frame than if you are, at year 1 of your investment period. Because you might get to year 6 and things are going well, but you still have a couple more years to get to liquidity, and all of a sudden you got this investor, breathing down your throat for premature liquidity on your company. So I think just understanding where they are in the fund cycle, and also just their philosophy on am I signing up for this needing to be $1 billion company, or are you going to be happy with a $300 million type outcome?
Yeah. Any other questions that you've heard from founders that were particularly impressive, or that you thought were valuable in sussing out whether you're the right fit for that particular founder?
I mean, one thing, I don't know if it's a question per se, but more that founders ask. But when a founder really knows their space, I think it's first of all, it's a really big red flag if you have an obvious competitor and you don't know about them.
Right.
So if you're creating a search engine and you don't know about Google, then there might be a challenge. So really knowing your space. But one of the things that I love is when you see an entrepreneur who really sees, their space in a new light, and everyone has that quadrant that where they're up and to the right. I have never seen, I've very rarely seen an entrepreneur when they're not in the top right corner and everyone's in the bottom left.
And if they are, then you're advising them to switch the axes to make sure that they're in the top right. Of course.
There's a few times where if they're putting themselves in the bottom left, then there's a challenge. But I think if they're able to very eloquently elaborate on where they are in the market and how they differentiate, other than being in the top right. Yeah. It's like, and I think Gartner has sort of driven us to everyone being in the top right.
Top quadrant.
But top quadrant. But I think it's like really, having a refreshing view, and then also, not necessarily pushing back, but saying, on VC's questions, because like we ask questions all day. But at the same point, it's like being able to say, especially to like, when you challenge the entrepreneur and they come back to you with, a very educated response that you maybe didn't think of. So I would definitely understand your market and sort of what are the dynamics in your marketplace, especially on the unit economics.
How does this fit question change on the LP side? John enjoys making investments and commitments to small funds, and then being able to invest in those at the B, the C, the D, the growth equity rounds. For the founders in the room that maybe have raised an A or B round, and now they're getting interest from non-traditional venture firms, how does fit matter, or is it just all about valuation and capital and speed?
I think that as you move later, especially in venture-backed companies, so
right.
Growth-backed is a little bit different, but in a situation where you've got a credible A investor on your board, it's each successive round. I think that strategic side is probably a little bit less important. If you've already got Mike Moritz on your board in the A, then like who comes into the B is maybe not as important. So I think the closer you get to liquidity and the more rounds you have, the more it becomes a pure kind of financial question. Mm-hmm. Valuation's more important. I think late stage investors, right? They don't know how to invest in pre-revenue businesses or kind of look around the corners of technology curves. They like to look at revenue charts and benchmark things to the public comps. So I think it's going to be more of a transactional financial exercise for the most part, but the folks at the late stages differentiate themselves by having a platform and a way to add value, and so that folks that offer that can probably invest in those late stage rounds on better terms. Yeah.
Well, let's get in the conversation about value add, which is an overused term in venture, but we'll get to that in a second. But before we do, anybody holding a microphone have a question out there that we can open up? Let's have some questions from the audience.
Sure. So I had
if you don't mind standing up and just maybe sharing with you your.
Can you hear me like this?
Maybe your affiliation to Cal and what year you were, and
sure.
And then go ahead with your question.
Okay, sure. I did my undergraduate here at the Haas School of Business, and I finished in 2010. And then my background is that since then, I guess I took some of the models that they did, and I went into public school education because I was looking at public policy at the time. And so I've gone into ed tech, and now I'm looking at trying to do vocational retraining. So I've been going to lots of different meetups and entrepreneurship sorts of things around the Bay Area. And then, so I was curious if you guys had tips for people who are interested in trying to start up a business, but let's say half of the entrepreneurs here aren't close to Series C yet, and some of us are looking at accelerators first. You mentioned Airbnb earlier through Y Combinator. So I was curious if you guys had tips on how people find funding up front, develop a good pitch deck, move forward, find good people to work with, and what's the general time it takes to move from each of the series and progression instead of just raising money. And then also separately, I was told earlier this week that it's really important to ask questions of your VCs where you want to make sure that whoever you find, because everyone can offer you and provide you with financial support, but you want to find someone that is invested in helping you grow your company and providing the business strategy as well. So I was curious what any of you or all of you had to say about that.
Cool. Let's go to the second question in a second. On the
Sure,
first
sure,
side,
come to
with
that.
respect, because we're going to get to that topic, but on the ideation, so founders are just literally at inception of coming up with an idea, of formulating their thoughts about how to convert this crazy idea into a viable business model. What feedback do you provide to folks that are at that stage, and what avenues should they pursue? And let's do a rapid fire round here of quick ideas that you would provide. What was your name again? Victoria. For Victoria and others in the room. So resources that founders should explore at that stage.
I'll start. We don't look at ideas that early. We don't look at ideas. We like to look at companies that have customers and revenues because we're focused on deploying a large amount of capital. We typically don't write checks less than $5 million, which means we're taking a whole A or participating in a later round. I would say go to Y Combinator because, in my opinion, they have some of the best resources online, and they can even kind of walk you through the process step by step, and you can upload your progress. They've got some great progress trackers, both for qualitatively and quantitatively. That would be my recommendation.
What else?
Yeah, you know,
Don't you run a school or something,
I
Wes?
do. Thank you,
Tell us
Michael.
about that.
Thank you for mentioning that. Son. Yeah, we actually do run a program called Pre-Seed. We're at the Impact Hub in Oakland, in Uptown, and usually it's the last Friday of the month. So we do it once a month. It's a 2-hour workshop. We do 1 hour just kind of talking about early stage fundraising, and then we do the second hour of pitch practice. And it's open to the general public. It's free. Anyone can come in. Just kind of have like a space limitation.
And pitch practice, is pitch practice just solely on the idea of raising capital, or is there something else about that pitch practice?
It's a safe environment to practice your pitch. So when people show up and they don't even have slides, we just encourage them to go ahead and pitch. And what you do is you pitch for 5 minutes, and then there's usually another 20 to 25 people in the room, and we do a very quick round robin. Everyone gives like very quick, constructive, what you did well, what you need to improve on. So it's a safe sort of environment to do that. But the early stage is very iterative, and and sort of high resolution in terms of, no longer is it, you sort of decide you're going to raise you decide you're going to start a company and raise a round, and you just go out and you're going to raise $1 million. It just doesn't work that way anymore. You start with small amounts. Maybe you raise 50 to 100,000 from friends and family. Maybe you apply to an accelerator. I mean, obviously YC is one of the best ones out there, but there's Techstars, there's 500 startups, there's a bunch of there's so many accelerators out there now. There's pitch competitions, launch here at Berkeley. I mean, all those things that you can do are great ways to get feedback on what you're doing from smart people, even sort of any business plan competition that you can enter, and you just kind of start this iteration, and then once you're getting some progress on your minimal viable product, you can go out and raise your pre-seed round. So there's just kind of an iterative way to do that.
I would also add, and for those who are in the Bay Area, the Berkeley Skydeck, which is off campus, it's the incubator for both students and alumni, is open to all alumni. So they have events there every week focused on this very topic, and some focused on ed tech. And there's an Imagine K-12, which is an incubator started by Tim Brady, who's one of the early guys at Yahoo. I think he's now actually part of YC. So they do have quite a large education presence.
Yeah, I mean, I would encourage you guys to leverage Cal and leverage all the resources that are available here. I mean, surprisingly enough, even from the alumni perspective, there are still plenty of opportunities to do that. Launch provides that from a business plan competition process. Obviously, Skydeck. We moderate a program through B Partners called Cal Founders, where we get founders together in small rooms to vent and to talk about issues that you're facing as founders. There's all sorts of resources on it. The one other feedback I would provide to you personally is, be careful be careful of the source of advice, right? Because some investors might provide you the advice from the context of them being a Series A investor, and others will provide you the context of being a pre-seed investor. And so just be mindful about the feedback. If you ask enough people, you're going to get the full spectrum of ideas and guidance. And so then it's really up to you to make those decisions. So Yeah, go ahead. Another question from the audience.
Hey, how's it going? Bernardo Cordero, MBA 2012. Is this working? I'm working on a company builder in Mexico. So I wanted the perspective on what you guys are seeing in the region in terms of investment portfolios, firms going further out in the US to look for opportunities to grow their funds and to get some of those companies that are starting elsewhere.
Great. Yeah, we're constantly focused on the Bay Area because there's so much activity here. But John, maybe you can share with us a little bit both. And what stage are you in right now? Have you raised any capital? Are you early? Where are you?
Yeah, so we're finishing up raising capital for the company builder to start the different fintech companies we're working on.
Okay, great. Yeah, so maybe you can give us some context from the early stage.
Sure.
and
So
beyond.
we're very active in looking at emerging markets and developed markets even outside the U.S. to back venture funds and tech companies. Our sort of nexus of Latin America, we have an office in Sao Paulo that sort of covers the region from an investment and sort of a relationship client management standpoint. And in Latin America, it's, there are really two really important economies, Mexico and Brazil, and then there's a lot of other interesting markets, some of them uninteresting. I would say in Mexico in particular, we haven't done any investments there yet. I have a couple of clients, family office client that's, I think, invested alongside 500 startups in a fintech company. So we're starting to see more activity in the Mexican venture market. It's a unique market like all of these countries are, where I would say maybe more risk averse historically. And we're starting to see the private equity industry take hold there, and venture in particular, we're seeing more startup activity. So it's, I would say it's on our radar, something to track. We've got clients that are already investing there. I wouldn't say, there are local funds there that are building, credible platforms. But I think it takes some time to have the depth of ecosystem, that a place like Silicon Valley has, obviously.
So should founders who are international based, should they be coming here to raise capital? There's so much capital here and there's so many investors here, but what's the perspective from you guys as to whether they should come here to raise or find local capital?
So my mentor, who is a legend in the Valley, he always says, if you want to be an actor, go to Hollywood. If you want to be an entrepreneur, come to Silicon Valley. And that resonates with me, and I'll just share some stats. I'd never pulled this data. I'd always suspected it looked something like this. But at GV, we're an operating partner model. We've got about $2.5 billion in AUM, assets under management, and about 272 active portfolio companies. So we have an operating partner model. Maybe this will be a segue as well.
Yep, for sure.
Which means that we have 70 employees, of which 15 are investing partners. So like myself, we source deals, due diligence on deals, structure the terms. If we take a board seat, we'll take the board seat. But then we also have operating partners, which are people that have a functional skill set. And we have 45 of those. Our superpower is design, but we also have product management, engineering, marketing, recruiting. That's an important one. So we like to have a presence, feet on the street where we invest, and as a result, we only invest in the United States. In fact, I could even break this down further. We invest into companies that are incorporated, founded, headquartered, have the majority of their employees in either the United States or the European Union plus the UK. And when I actually went and did the data, so I ran some quick numbers before I came. Well, I guess they're not officially
not yet.
Brexited
Not yet. You might have.
That's true. So I can still say European Union.
But you are very forward-looking.
There you go.
At GV, so it's nice you've already changed your language.
So of the 272 companies, so 90% of them are in California, Massachusetts, and New York, and then 70% of them are just in California. 64% are in the Bay Area. 37% are in San Francisco.
Wow. It's remarkable how concentrated it is. And yet there's great opportunities outside of it. We've seen some incredible exits happen well outside of the Bay Area.
Yeah, I was going to say, I think the Bay Area is the most important market if you're investing in venture, but there are huge outcomes that are happening around the world, whether it's Western Europe, whether it's Latin America, and certainly Asia. China has, when the U.S. venture market was in the doldrums, China was a very attractive place to have had capital. That venture market has matured, and there's a lot of hot money there now. So probably it's not as attractive as a market like India, which is kind of coming into its own. There are unique challenges there. Getting liquid's one of them. But I'd say like probably most interesting for us as an emerging area would be Southeast Asia. So we're seeing Singapore is sort of, the launch pad to the region, and whether it's Indonesia, Philippines, Vietnam, I mean, that's one of the last bastions of really large populations and underpenetrated in terms of smartphones and venture investment, et cetera. But so I would, I agree. I think it makes sense to focus one strategy in U.S. and Europe, but there are big outcomes that are happening outside the U.S. and I think that trend is going to continue as these entrepreneurial ecosystems, have more depth and there's just repeat entrepreneurs and more capital providers there.
Well, and from the entrepreneur's perspective, if you're in one of those regional markets and you're looking for capital, the worst thing you can do is spin your wheels talking to a bunch of folks who don't write any checks to companies that are pursuing those particular markets. And so we would highly encourage you to start the conversation with, have you ever made an investment in a company domiciled in Vietnam or domiciled in Mexico or wherever it might be? And if they say no, maybe you spend 20 minutes with them versus an hour, because time is definitely your most valuable asset. So keep that in mind as you're figuring out whether there's a right fit with your investor. That said, as you pick up local capital, you might be able to find opportunities to take capital from Silicon Valley investors that will make exceptions to their particular rules. I want to move to the, no, please go ahead. Yeah, we have a question from the back.
Hi, my name is Chida. 2016 EWMBA. Actually, we started a company last year. It is AI-based portfolio management. We do fundamental analysis and invest in public equities. Actually, we are launching our first ETF run by AI in June, called AIEQ, New York Stock Exchange. So we are a kind of camel, as you explained. we are given very list amount of equity with the incubator, like founder space and plug and play. My questions to you, we have two scenarios that we can go and raise for VC funding and go a little bit faster, or we don't raise anything. And so if there is a scenario that you don't need to raise it, is it still advisable go and partner with the VC firm that give you strategic advantage?
That's a great question. So you have a couple paths available to you. You could potentially grow a little bit slower or pick up additional. And go ahead. What do you mean? What do you mean by that?
Well, just as we were talking about earlier, you can grow slower and not take on a capital partner and really control the business. And once you bring on that venture investor, and depending on how much control they have, they are in a position to fire you if they don't like the way things are going.
Yeah, but Lev, we don't really control companies. I mean, is that fair? Is that a fair statement from like that VCs will control a business per se?
Hopefully, they're not controlling a business day to day.
Okay.
It's a VC's job to make sure that their capital is deployed wisely, and that I think going to the prior point, most funds are set up as a 10-year life cycle, and most LPs don't like stock return to them. I think everyone prefers cash. So it is a most investors deploy capital in the first 6 years and then try and harvest it years 7 through 10. So that is return their capital to their LPs. So you have to be cognizant of sort of where you are, as we talked earlier, where you are in their life cycle, but at the same time, the VC is responsible for the company, not the entrepreneur. So they shouldn't be micromanaging the entrepreneur.
But the implications for the gentleman in the back of that reality is that what? That if he takes capital from a venture capitalist, that the expectation is that there's going to be a point of time where the conversation about returns is a conversation to be had, and you should expect that.
Yeah.
Right.
Yeah, I mean, once you take money from a VC, you're signing up for a particular economic outcome, right? And so the VC, to Lev's point, which he was getting at is, as a VC, if I have to manage at that level of minutia, then I have the wrong entrepreneur or the wrong CEO in the seat, right? So that's not a good thing. But in terms of control, it's more around at the board level, especially at the early stage, the composition of your board is unlikely to include, if you even have one kind of independent director, it's all going to be financial types. Maybe you'll have a couple of board seats. I mean, and, if you're a super hot company, then you're going to have some exotic structure to make sure you maintain control. But that only happens after you've proven that you're going to have a multi-billion-dollar outcome. So in the early days, as you're growing, the VCs, they don't necessarily have control per se on a day-to-day operating basis, but they do at the board level. Right? That's where the control happens, and that's where those decisions can be made to evaluate the entrepreneur and their performance, and are they guiding the company towards that financial outcome that the investors need as part of their fiduciary responsibility.
Right. Now the downside, obviously, is you don't have that partner. So Wes, maybe you can walk us through how you partner with your companies, and perhaps why it is beneficial to strongly consider picking up a financial partner.
Yeah, that's a great point because we're in the business of providing capital and financing, but we're bringing other things to the table. And we view the thing that Rick and I love about the seed stage, VC seed stage, is that it's a craft business. We don't really want to grow up when we get older and go to Series A. We love the seed stage because we can be so impactful and influential in the outcomes and helping these really early stage companies, figure it out, pivot if they have to. And we view ourselves as that bridge from, just after inception to a Series A. And there's a lot that happens there, especially these days. The bar has really risen to raise a Series A. And now you're seeing, pre-seed rounds and then seed rounds, before you even get to Series A. Who knew that there was a round before seed? But there is a round before seed, and there's so we like pre-seed, like kind of post-pre-seed. Seed is kind of like where we fit. It's kind of like that's our real sweet spot. And looking for camels, ideally. But our strategy at Better is to have a large enough portfolio that we have sort of enough shots on goal because, trying to get that 6%, but small enough that we can go deeper with our capital and have a higher ownership stake, but also have, not so many companies that we can't spend the time with all of our portfolio companies. And usually right after we invest, we're typically meeting with our companies, a couple times a month. Eventually we go to monthly once we feel like they're on a really good path. But we help with a lot of different things. I think probably the most important thing we help with is helping them focus, setting forth the milestones on where they need to be. Like you think about, okay, how much did you raise? What's your burn rate? How many months of runway do you have? What's that next big milestone? Is it profitability? Probably not. It's probably getting to the 200K ARR or whatever it may be to raise that next round of capital.
Who's setting those though? Is it, the founders, you, Rick?
We do it together. Yeah, mostly just Rick.
Just Rick.
Yeah. We do it together, in conjunction with them. We try to bring our knowledge from our position in the industry and kind of seeing what other portfolio companies have done and what kind of traction they had when they raised their next seed round or when they raised their next Series A round. So that's one of the, sort of bigger picture, helping them focus, hey, don't do that right now. Don't go after that market right now. That's a great market to talk about at Series A to show the expandability of the product, but don't go in that market right now. Let's stay focused on the energy market so you can really penetrate that and then have a nice story once you get to Series A about expanding to other markets. And then there's other like tactical things. Rick and I, we do quarterly offsites, which is one of the things you can do when you have a two-man shop. And we were riding our bikes to Point Reyes Station yesterday, brainstorming about the different things that we need to be doing. And one of them is, building out our bench of people that have really great sales ops experience. And we've got a few, but we could do better. And this is a big question for so many of our startups. It's like you have a great product, and then what? How do we build a sales organization to really get up to that 200K? Because these days, Series A, you need revenue. You can't just show up as Sequoia and say, hey, we got a great product, great story, help us generate revenue. They're going to say, come back when you've got 100 to 200 ARR. So that's one of the sort of tactical things.
Love, if there's one thing and one thing only, broadly speaking, that a venture firm and a partner can do on behalf of their portfolio companies, what's that one thing? And then maybe you can share with us what you guys do at XSeed as well.
What is the one thing you can do?
The one thing that's the most important thing that if your venture firm and your partner, your financial partner does X, then it's been a positive. Then they've earned their right to continue to invest in the company. What is that one thing?
Well, I think the thing that that makes both entrepreneurs and VCs the happiest is when you help a seed state, one of your portfolio, land a customer, a really large customer, because when they're very early on, and it's super hard to get metrics, right, to prove that your product makes things faster, makes it cheaper, helps you deliver an ROI. So when as a investor, I think helping them, introducing it, a lot of times the founder will be very technical, not necessarily have the network. So if you have a network that can help them land that sort of first really big customer, I think both as the VC you're very happy, and the entrepreneur. So I think that's one thing, and the other is just helping them hire the right people. It's so important that everyone talks about culture, but build that culture that you want as an organization and as a VC, and help them really hire the right people. Because you can hire great people, but are you hiring the right people at the right time? Because sometimes you can hire someone that's not fit for your stage.
Yeah, Lo, maybe you can comment on this, because you're looking at looking at these companies at the A. Yes. And so you know what greatness looks like at the A at least. So
but I was just going to say, I think that nailed it. I would just drill it down to network. And this is why I think when I was thinking about becoming a VC when I was here, I saw two different types in a generic sense, of VCs. I saw the financial types that kind of came out of, maybe it was investment banking, private equity, or they went straight into venture. And then I saw the folks that had operating experience. And the thing that resonated with me was, the finance folks were great at later stage, looking at the numbers, doing the math, looking at comps. But it seemed like the operators were investing at the earlier stage, and they were leveraging their network, right? So they have the ability to kind of get a customer, right, to help you get the right employees, and then working the phones to help you get financing downstream. So I just think the network is the most important thing that you can provide if you're an early stage venture investor. I think seed even to Series A where we are. I think we take the model a little bit further, and at GV we have, like I mentioned, an operating partner model, because we know that there's only so much value that a partner that's on the investing side can provide to their entrepreneurs. Maybe they're seeing them once a month at a board meeting, or maybe it's once a quarter, and they're thinking typically more high-level strategic issues, kind of, what's happened since the last time we met 30 or 90 days ago. But what we learned at GV is that the ability to be able to help the entrepreneur with the things they're thinking about on a daily basis, which are more of those, hey, I got to hire a new director of engineering, I got to prioritize my next quarter's roadmap, I need to be able to, I don't even know, get the right customer, whether it's kind of, a consumer model, increase my conversion on top of funnel, or whether it's a SaaS model and kind of get that logo that I can put up that's going to attract the logos in this sector. So that's why we decided to do the operating partner model, because we can have people that have the network specific to that functional role. We've done things like with our design partners, we've embedded them into a company that needed to develop the design competency. They didn't have a design team. They didn't know how that should be structured. So the individual went in, spent a quarter with the company. First month was kind of just implementing a model of where that should sit. And then the next was kind of hiring that person that was going to replace them. And then the next month was kind of training that person on kind of what it means to be a design professional in this stage of company. So, I think those are the types of things that are necessary as we evolve as an industry. And it is important for us to further enhance, adapt our model, and with the abundance of capital that's in the venture space, differentiate, because we don't want to just be another check.
Well, GV is on the top of the list for founders globally to attract as their lead investor for largely that reason of the operating partner model. Questions from the audience? Are there questions out there? Yeah, go ahead. In the back.
Hi, my name is Epiphany, and I graduated last year from the undergraduate program. And I'm currently working at a small business in San Diego with about 4 to 5 years of R&D under our belt. And we do a lot of military research. So Department of Defense, we've gotten funding from the DARPA, from Navy. And I'm wondering how you view, if you've ever invested in companies where their initial target market is military or defense agencies, and how you view that relationship. Because we're looking to raise capital, because we're now at that point with our growing patent portfolio, commercialization and how to go into market. Specifically, swarm technology, so UAVs and swarm algorithms.
So there are venture funds that are just focused on defense and government. Like the CIA actually has a venture fund. It's called InQtel. There are a number of. Can you guys hear me? Yeah. There are a number of venture funds that are just focused on government, new technologies that apply to government and Department of Defense. I was saying one of them is InQtel, which is the INQ, the letter Q, and TEL. Don't ask me how they came up with the name. I didn't name it. It's the government, so. Yeah, and then the DoD also has a venture fund now called DIUX, Defense Innovation Unit Experimental, I think is what it stands for. Again, government.
That's
don't
nice.
ask me.
That's high quality branding.
Branding's not their expertise.
Yeah.
Yes. So in San Diego there are a number of investors that are very familiar with UAVs, and I think just selling to the government is usually very difficult. So usually you need a partner through that. So like Palantir, which sells to 3-letter agencies, intelligence software. They were an InQtel portfolio company. So I think if your first market, and I would probably recommend going after other markets first, but if you're hard set on going after government first, then I would partner very early on with these folks that can accelerate their process.
Lev, maybe John has a couple, because I mean you know all these fund managers, and you're a San Diego guy too. That's so right. Yeah. Got to talk to after the panel. Right. But who else is out there looking at defense?
Interesting area, certainly. There's a lot of spin going into defense, and there's interesting technology that's coming out of that. I think the case study of what InQtel's doing, and like on the security software side in Palantir, it's obviously a great case study for a great company that's really selling into government. I have a cautionary tale. This isn't a company that we had direct investment in, but we're in it through a fund, and it's on the in the Northeast. They have like a next generation fighter ship, if you will, something that's a very advanced technology that the government's very interested in, and it's so strategic that they were operating under the assumption that the federal government, DoD, was going to be their first and very important customer. And what happened is the budget didn't materialize. They basically didn't fund the project. But they also tied the hands of the business. They wouldn't let them go and sell it to the Saudis or to some of these countries in Asia, because it was such a strategic technology. So they basically strangled the business. Wow. So that was that was not a good outcome, and it speaks to the risk that Lev mentioned. It's really you need to have extreme clarity on where you stand with some of these initial customers, and I think it's generally a better model to harvest the military technology and try and apply it to some interesting commercial sectors. Because I mean, UAVs, that's a very, attractive area. There's a lot of, and we're seeing that in San Diego, right? Because there's an ecosystem of, defense in Southern California. We probably see, our fair share of those types of startups. SAIC's down there. So there is a lot of this interesting military technology, but it's, I think you just got to be careful on how to go to market, certainly.
Interesting. Other questions from the audience? We have a couple more hands over there. Yep.
Yeah, hello, it's Christian Eder from class of 2012. Question to the early stage VCs. Their exit takes a while, until the company has $100 million of revenue. So how often do you get your liquidity event returns from later stage VCs? And because it's 10 years, and for the founders and seed investors, you probably want to make your money before that. If we can talk about that.
So you're asking about what we would call the secondary market, or being able to exit the position in a later stage round?
Yeah, exactly. If Series C and D happens, right, yeah. Do you usually just wait? Is it like a nice book return that you use to raise another fund? Or
Great.
do you actually get some hard cash out of it?
So for those of you in the audience, there's quite a lot of activity that's been happening for the earliest stage investors to be able to sell some of their stock and some of their positions once a company is actually raising a Series C, the letter C, D rounds, and the like. But let's hear from the panel, because I think there's a lot of experience here.
Yeah. So we're very active on the secondary market. We primarily buy funds from LPs that are years into their life, and we'll try and buy that at a discount, so we're buying a portfolio. But we also can buy directly into companies in a direct secondary, and have done that. And we've definitely seen dramatic evolution of the secondary market, both direct secondaries and LP and structured secondaries. The market has grown exponentially. I think it's sort of philosophically, for years in Silicon Valley and in venture, it was anathema for a founder to sell before the VCs. It was like they're just non-starter. You don't get liquidity until the money guys get liquidity. And I think fortunately that viewpoint has changed. So there's always problems when founders take liquidity, and that changes alignment. And it's pretty relevant to like what we look at in growth equity, because a lot of these businesses, because they're profitable and they were bootstrapped and they're owned by their founders, if I'm a private equity investor trying to get into that business, like my best way to get in is through a secondary. So I'm buying up founder shares. Maybe it's from a founder that left, but if it's the CEO who's running the business and he's selling 40% of his shares, what does that say about sort of his view on the upside? So, I'm constantly being challenged in investment committee on those situations on the growth equity side. But putting it in the venture context, I think it's increasingly been used as a tool to enable founders to take a little bit of liquidity to, buy a house, fund their child's college education, whatever it is. And what's great about that is allowing that little bit of liquidity can be aligning for the venture investors too, because that founder might be less keen to sell for a low ball exit. The first acquirer that comes along offering $100 million, if somebody really needs the money, that's going to be a very attractive outcome. But if they've taken a little bit of liquidity off the table, then maybe they want to stay in and shoot for the larger outcome. And so in that regard, I think selective secondary liquidity is a good thing.
Great.
I was just going to comment on that, because I love that point. I think we do, as VCs, as an industry, you need to be able to better understand, is the entrepreneur going to go buy a Ferrari and a house in St. Helena? Or, as I've experienced, not a deal that we did, but I saw an entrepreneur who needed to move because his company was relocating from Europe to San Francisco. He didn't take money until it had hit the hockey stick. And he needed to buy a house and put his kids through education. So he only sold enough to buy a modest house, but modest in San Francisco is still expensive, and put his kids into school. And then his interests were exactly aligned. And then everyone was like, now we can rest easy to know that he's going to go for it.
And that's a good question to ask your potential financial partner as well, about whether they have a philosophy around founder compensation and founder equity. And now there's some other questions in the audience.
So my name is Ramon. I'm a full-time MBA 2012. I work currently at Samsung Electronics. As you know, we have a lot of teams that are interacting with VCs constantly in the Bay Area. We have 3 funds, actually not just one, but 3 corporate venture capital funds. We also have M&A team doing acquisitions. And then my team, it's the open innovation team. We work in partnerships. We essentially look for startups that have interesting technology that we can actually put into Samsung products, Galaxy phones, smart TVs, wearables, VR, etc. Right? I've seen the process of actually sourcing these startups with interesting technology seems to be a very ad hoc process right now. Like as someone mentioned, we have a network of people we know, and then we just talk to them. Hey, do you have something in AI? Do you have something in AR, VR, etc.? It seems like a very inefficient process, right? So I was kind of curious about what are the best practices or the best processes that you have seen in terms of corporations sourcing innovation from startups in your experience, and also maybe if you can mention some horror stories and some like things to avoid, that would be interesting as well.
Great.
Thank you.
So how should companies and large corporate source opportunities in a more proactive or more efficient way than perhaps what they're doing right now? Should they do it? I mean, there's a lot of ways to do it, right? I mean, they could make commitments to funds, and that's been done in the past, right? Relationships with early stage fund managers like Wes Love and Lo. Partnering with groups like StepStone and John to identify great fund managers that are focused on those particular sectors. But on the ground, boots on the ground, how's it actually work?
Yeah, you nailed it, right? You can, as a corporate, you can be an LP, so you can be an investor in venture funds and almost use them as a scout to say, right? You can start up your own venture fund as a corporate, so you can set up a corporate venture fund, which again, unlike GV, which we invest for financial return, most corporates invest because they would like to be able to have access to either technologies or business models that are innovative or potentially additive or disruptive to their business model. And then you can, I think some of the better models that I've seen is the model that, well, of course, that we use at GV, but also Andreessen Horowitz. I would even say, Andreessen has a larger team dedicated to working with corporates. So they have an executive briefing center, and they have a whole team of people that focuses on building relationships with the right people within corporates to be able to bring those corporates in. And then if they're interested around a particular type of technology or business model, then they'll pull in the companies from their portfolio and parade them in front of the group, and things happen. We do the same thing at GV. We have a few people that just specifically focus on working with the largest corporates and then kind of helping them understand, well, here's the things that you should be aware of. Here's what we think might be interesting. Here are the trends that we're seeing. And by the way, here are some companies that are executing against these models or have these technologies that we think should be on your radar. So I think, those are the typical models. I think part of this resurgence that you're seeing with corporate VC, and hopefully it won't just be kind of, like people there for the party, and then when the cops come, they scurry out and go home. The cops coming would be the market, like not doing what we like it to do, which is up and to the right. A lot of people in the kind of the Web 1.0 phase, corporate set up their venture units, and a lot of them exited. Some stuck around. Like I was at Comcast Ventures. Comcast Ventures stuck around from about, like late 90s, maybe 99 till today. But what I think you're seeing is a realization is that as more and more industries are impacted by technology, corporates are realizing not only do they need to stay abreast, and that might be by, Samsung does a great job of having kind of innovative models, labs, incubators, all these different tentacles out into the valley, actually having feet on the street here. But I think also in actually putting your money where your mouth is and then setting up a venture group, even if it is strategically focused, to actually get into the market, work with companies. And I think another thing, what we saw in Web 1.0 was a lot of corporates structuring their venture units to do deals that could potentially be very onerous and have terms that could be damaging long-term to the companies and reduce their strategic agility to be able to bring in multiple partners potentially downstream. And we're seeing, like having things like a right of first refusal, ROFRs, and those types of structures. I think now what we're seeing is less of that. And even if a corporate is strategic in their venture activity, they're structuring their deals which are much more aligned with what a typical Sandhill Road investor would look like as well.
Well, unfortunately, we are out of time. I know there are a couple other questions. We're going to stick around, and so I would highly encourage you to come up and ask your questions specifically to the panelists. But I just want to, why don't we, a quick round of applause for our panelists. Thank you guys so much for participating.